all CEOs, me included, we don't actually know what we're doing.
They're all sharks, so all you got to do, though, is know shark behavior.
I don't think we've ever talked about this before.
We can capture all of the wallet share.
First place you start is with the product.
That's just the first nut.
This is the Capital Stack. Hey, everybody. Thank you for tuning in to the Capital Stack, where we talk to founders, operators, and investors about all things value creation in startups. Today, I am talking to a really good friend of mine, a guy who is a multi-time founder, somebody who has been there and done that before and is doing it again. And his name is Corey Kossack, and he is the founder and CEO of Aspireship, which is a marketplace for talent. Originally for sales talent. And I think there's going to be some iterations within that. I think we're going to talk a lot about that. And, Corey's a great guy. Known him for, a year or two, couple of years, and he's got a great story. He's been in the point of, having an early stage company, selling it, and then kind of building a company within a company and making that scale and understanding how that works, and then doing it again because he's a sadomasochist. Corey, what's up?
Hey, thanks for having me. That was quite the intro, and I don't know how you know me so well.
I do. I'm actually blacked out right now. I have no idea what I'm saying.
That makes sense.
Yeah, I took a lot of Xanax.
Yeah. Okay.
What's going on?
It all comes together.
Yeah.
A lot. It's been quite the year already. It's quite the year last year. And wow, what a time we're living in.
Yeah. It's like, do you ever think there's going to be a time when it's like, we're not fucked up? I mean, like pre-2019, like, hey, things are okay. There's not like this like huge intensity in the media regarding politics, regarding economic stability, around war. Like, do you think we're ever going to kind of come to it like peacetime again?
Oh, geez. I've just learned so much over the last couple of years that it makes it really difficult to say yes,
Right.
Which is unfortunate. I know about a whole lot of things that I didn't know about before. And there's a lot of stuff that's pretty broken.
That's true. That's true. It's like the stuff was there before. We just didn't know about it.
Yeah.
We didn't know that like there has been no interest rate, or 0% interest rates for 10 years, way before the, COVID, right? That wasn't a system of COVID. That was a system of the GFC, but nobody remembered to turn that off.
Or that it really mattered all that much.
Right.
I mean, I remember reading like financial blogs and stuff like that, Market Watch. And it's like, why is everybody talking about interest rates all the time? Who cares? God, they're so sensitive, And of course, humbled, then humbled again, then humbled again.
Mm-hmm.
And so here we are. I think what's interesting to me is I think in tech and in venture, we're actually exposed to this a little bit early. But I think a lot of mainstream just has no idea. And it's hitting us early, and it started last year. My guess is that it's going to hit everybody else sooner rather than later. And then they're going to know too.
You mean like tech feels it first and then, right. Yeah. And then the rest of it, everyone's going to get punched.
Yeah.
in the
Like
face.
Everybody else is like, oh yeah, everything's fine. What are you talking about? And then it's like,
especially the consumer, right? Like in our universe, all we see is Twitter and LinkedIn, and, everything is, on fire. Even though I still feel like it's still artificially kind of like propped up, like people just haven't run out of runway yet. Like it's just like, God, there's a lot of runway still yet to be had. But what's interesting is, and this is kind of like a redeeming thing that I felt, is that, we've been in a recession, meaning the tech industry for, 12 plus months of, just decimation in the public markets, basically just a rapid shut off in the private markets. And I was asking a hedge fund guy, I said, so like, where do people put their money right now? Like, because I remember back in the day, everyone put their money in oil and gas and like pipelines and shit. And like you would get a dividend and everyone was excited about that. People were talking about Caterpillar. That was like when I first started trading. And like, I think Jim Cramer was actually like a reference point of like truth rather than just being like a total buffoon. Right. I'm like, why does everyone hate Jim Cramer now? But anyway, like I stopped listening, and he was like, oh, people go back to tech. And I'm like, what do you mean people go back to tech? And he said, well, it's kind of like the it's like the least shittiest house on the block, because when you look at sectors when there's no growth, the thing that's usually the most oversold is tech. And you'll start seeing money coming in there because oil and gas commodities are, not good. The price of oil goes down. It's all shitty, right? And so like, it's not going to have like insane growth, but there's going to be a little bit more confidence in there because there's going to be at least some yield.
Yeah. And one of my sort of beefs with the system of venture is the rules just seem really outdated, right? The power law, the step up in rounds where like you go from raising a pre-seed of 500K to 1.5 million to then in 2 years, you're at like the $25 million Series A and then $100 million this. And it's like, why do the step ups have to be so large? I think as a founder, you look at that stuff, and even when you're hot and things are really going well, you're going, well, I know I need to fit into this box because this is the next stage. So I'm supposed to be at between this raise and this raise and this valuation and this valuation, no matter where I'm at, because nobody's in between. And I wonder if, and I'm, just a founder, right? Scout investor. I've done a little bit of angel stuff, no big deal. So I have not dealt with all the things that all of you have dealt with in terms of looking at how to actually generate returns. But it seems to me that if some of these things were just right-sized to not so much capital at every stage, you could actually change the way this all goes and actually generate better returns and fund better companies that don't have to rely on insane swings to catapult them to the next step.
Yeah, I mean, I believe that. I mean, that's pretty much kind of our underlying thesis is do more with less and, have optionality to sell and not have a binary outcome. I think with there's like, and I don't know if that's right or wrong, because I think there is something, if I was to strongman it, about there's just inherent risk in early stage, no matter how big of a swing you take, right? You can fail, right? I mean, you're dealing with large incumbent fund players, you're unproven, et cetera, et cetera, et cetera. So there is a level of return needed to make up the losers, right? But how much of that matters, right? And like, look, what is the optimal amount? I mean, so I've been doing this for 7 years, and I wouldn't say that I have a proven track record. I mean, I have a track record. I don't know if it's repeatable or not, right? But I'm still, chugging along. And I think that I'm yet to be convinced, rightly or wrongly, that power law is the way it's supposed to go. Like, I can understand it from a coastal perspective. You have X amount of money. You need to have these kinds of things. It needs to be a big idea, and you need to keep marking up to keep raising money like that. Those incentives are perverted, but they're very clear. You know what I mean? Like, they're there.
Yeah.
But can you raise a fund? Maybe it's just the fund structure. I think it might be, I think it just might be funds. Like investing in companies doesn't have to be through a fund.
And even if it is, it doesn't have to be so much. And I understand there's the management fees and all that stuff, and it's all tied to the amounts and all of that. But yeah, I think there's something missing here. And I'm sure I'm not the first person to say this. And there's been many people that have challenged it and gone out and tried things. And then, most of them suck and all that stuff. But I do think it was one of the things that struck me when we first met and you talked about what you're doing and the way you think about it is pretty uncommon in terms of just sort of like, it's almost like a hedge.
Yeah, it is a hedge.
I'm going to pick well. Yeah. I'm going to do my diligence, and I'm not going to be looser on it than any VC that's shooting for the multi-billion-dollar outcome. But I recognize that I'm going to have more hits in the middle than a lot of them where it's just like, hey, you're either worth $10 billion or you're dead to me.
Right.
But
as a founder needs to be able to say, okay, but I'm not going to get the market valuation of power law.
Sure.
Right. And they have to wrap their head around that. Well, my friend got it, but he got it from an LA VC.
But so here's the thing. So from founder's seat, it doesn't actually mean anything to me, really, unless I'm doing some kind of secondary or something like that on it. Right.
That's a good
Because
point.
otherwise
It's all bullshit.
it's all bullshit.
You're right.
And I got to deal with liquidation preferences and things like that, which I honor, of course, because I care about the investors and I want the investors to be whole and then some. But if I go and take 20 million bucks from you and my exit isn't large enough to cover that, I walk with zero.
Right.
And it's like when maybe I would have walked with 5 million or 10 million or 15 million.
Right.
Right.
Something.
And so the risk on the founder goes exponential if you're not taking stuff out. And so it's just really interesting. I think there's been a lot of stuff, as you said, the fund structure, I think it comes from the top, right? It's like it's designed this way. And so it trickles down to everyone, and the TechCrunch and everything puts out all the stuff saying like, oh yeah, big valuation, whatever. And so every founder goes, here's what I need to do. This stage, this stage, this stage. I got to get the big valuation. It's like, why do you care about the big valuation?
Yeah.
Because, you better be worth $1 billion or $2 billion.
Yeah.
Or
Eventually
$5 billion,
someone's got to bring in real cash.
or else like you just shot yourself in the foot, taking $25 million that you didn't need when 5 would have gotten you everywhere you wanted to go.
Mm-hmm. Or at least to a point where you could still take more liquidity. Right.
Right. And so, so it's just really interesting. And so I think I've always felt the mismatch there. And now that ventures feeling the pressure of course, the economy changing so quickly and rates changing and all that stuff, and actually looking at some of these returns and going like, it's actually not that great.
No, it's not that great for the price of illiquidity.
Yeah.
Right. Like I think we were just talking about it on LinkedIn.
Yeah.
I mean, if I was to take a 10-year fund, which is nominally more than 12, right? Sometimes, funds are 15, 20 years, right? Based on all these extensions that they have. You're talking about 2% a year. That's 10%. That's 20%. So that's 20%. So basically, if I give you $1, I'm actually only getting 80% of that invested. And then once I get my money back, so once I get basically, you have to make 120% of my capital commitment come back to me. Then you take 20% profit. So then I get only 80 cents back. Mm-hmm. Is that worth it?
In 10 years.
In 10 years.
Right.
Thank
and
you.
it's like, well, it is
right.
if the outcome is massive.
Right.
But again, then you look at power law and all that stuff.
Right.
And it's like, well, it's not really that massive. Or certainly it's not when you look at some of the things. And again, I'm no expert here. I'm just like a student listening to smart people talk. But you look at stuff where like DPI is 1.6x
right
in 7-10 years. And it's like,
and that's the average, right? Like that's the average. But if you look at like the top decile where I can't get into, you're looking at probably 3 to 4.
Yeah.
Right. But that's not available to me. What's available to me is every, VC huckster trying to raise a $15 million, $25 million fund that's looking for $50,000 to $200,000 checks that doesn't have a track record. And I'm supposed to believe because you're an emerging manager. And God forbid I ask you what your DPI is because you might be offended. Right. And I get it. Like smaller funds, you're hungrier. I don't like the big fat funds where like no one's doing any work and they're just collecting fees. There's an argument to emerging managers. I'm an emerging manager. But there's something to consistency and track record that I think is also valuable.
Yeah.
What does Aspireship do?
I didn't come here to talk about that. So
this is just us catching up.
Yeah. So
we should light us. Do you have a cigarette? Like I feel like we should be smoking a cigarette.
I don't smoke. Sorry.
I don't either.
I can't.
But I would smoke a cigarette.
I can't hang with you. I got 4 young kids, and you have kids too. You're
Fuck
a girl
'em.
dad.
Yeah.
It's all right. Okay. So Aspireship was really born to help people with career mobility, right? That's really what it is at the end of the day. I saw a problem where people just got completely blackballed essentially, or typecast based on whatever their past job was, right? It's like if you decided, hey, you're not going to be a fund manager anymore, and you're going to go off and do something, and you're just like, David, sorry, like, you're a finance guy.
Or you're a CS person and like, you want to try sales.
Whatever it is.
Yeah.
And I mean, it's ubiquitous. It is all over the place. Mm-hmm. This is a problem that's pervasive.
I love that typecasting. That is what it is.
Yeah, it's typecasting, right? And it happens at every level with everything. And so I'm like, this is just such bullshit. And like, I'd even manage really top performing people that internally couldn't get promoted, couldn't get a shot for like a sidestep into something. And so I'm like, okay, there's got to be a different way to do this. And all the Udemy courses, the boot camps, they just didn't really do it. So I figured if you could create a platform that could teach somebody how to do a job, and not just like generally, but like do a specific type of job targeted at an industry. And we started with the SaaS industry and sales, of course. If you could do that and then have them prove that they could actually be good at it, then you could convince employers that they should hire those people. And so that's effectively what we've done. We've changed the model like 10,000 different times with the economy swinging back and forth like crazy over the past few years, which has been our entire lifetime as a business. But effectively, that's what we've been trying to accomplish. And we've done a really, really good job at it. I think we just needed a little bit more stability in the economy so that you could create a plan and execute on it and not have to change every 5 seconds because everyone goes from hiring thousands of people to, now they're not doing anything.
And you, like most startups, start in the technology sector because that's where there's early adopters and that's where you can get traction and really, work on the product.
Yeah.
Right.
Yeah.
And then that changed.
Yeah. And so now really, we have some stuff hasn't even been announced yet, but some stuff coming and really, well, I won't. But
make this a capsule of time and then I'll announce it when you tell me to announce it.
Okay. So basically we have we got certified by the Department of Labor as a training provider to assist with apprenticeships, which is effectively what we do already. But at the government level, they sort of think of career mobility as an apprentice, right? So like, could you bring somebody on, teach them what they need to know, and then have them grow into the role? And that's effectively what we've done with all these people that have been typecast. And so we got certification there, which comes with opportunities for funding and things like that. And so it's going to be an
government
opportunity.
Contracts?
Mm-hmm, it's going to be an opportunity for us to change the game in terms of how I can go to market and work with employers who right now are like, how do I do more with less? And I'm not spending a penny on any type of recruiting service or any of that kind of stuff, which is kind of where things are at the moment. And I can offer them a different path, both for hiring and also for upskilling existing people. And I'm pairing that with growing through partners. So we're going to start launching programs through partners, partner-created content, which will allow us to go far beyond where we've been in terms of scope because the platform's ready to handle it. And now I have a real like commercial angle that's going to work for all.
So give me an example of a new customer for you guys.
Sure.
Yeah.
So currently we serve anybody that's in tech. So tech companies, anything from like a large publicly traded company to a startup, really. And with some of the new partner programs that are coming out, they will effectively apply to all industries. So by the time this podcast launches, I don't know when it releases, we will have announced revenue operations Aspireship. And RevOps is thought of as something that's like very deeply ingrained in tech because it is. But ultimately what we're talking about is, and this is through a partner, what we're talking about is here's how you set up HubSpot, right? So it can be for a small business. It can be for anything. It doesn't have to be for tech, right? And so
it's amazing that even like the landscaping companies that might do like $10 million a year, they don't have a CRM. They don't know how to manage. They don't know who's touching those people from who the contacts are.
Right. And my last company existed because all the small businesses didn't know how to do any of this stuff. So we just did it for them, through software. And so as you start to think about that, and then you think about, okay, what are the types of careers people can pursue in what industries, what disciplines, how do they get exposure to what they actually are, and then how to do them, and then how to get into it. And if we have a vehicle, which we do, to get employers to, adopt it at large scale, then we can actually like do the thing that we've been trying to do, that we've done in our little niche for the last couple of years, which is sort of change all this typecasting nonsense and help people with potential actually live happy lives and be happy at their companies. So companies don't have such turnover and lose money all the time.
So are you talking about like can you give me an example of like an industry of like the new kind of, at post apprenticeship certification, like what kind of company you would serve and the type of candidates that would typically be typecasted? Is it kind of like a reversal? Or are you taking like tech candidates now and they're getting laid off and funneling them into like, the restaurants? Like how is it working?
So where we're starting, of course, is what we already do. Right. And so these are people, they could be a nurse, a teacher, anything, bartender.
Stop taking nurses.
Right. Any of that stuff.
Do we need the nurses?
Well, I can do the reverse too. I had a conversation about that. Okay. But basically anybody that wants to get out of their line of work and they're like, oh, I could be good at sales and get their first sales job. So we have a lot of those people that end up as SDRs or, whatever.
Right.
We also have people who have done sales in other industries will go in, or they've done client services, any of that kind of stuff, account management, and they'll go in and actually be an account executive, or they'll be a customer success manager. And that's all like tech company focused. Tomorrow, it could literally be anything. I think the first example, as I mentioned, with being RevOps, if you train somebody to figure out how to look at a business and say, all right, I got to go set up a CRM, set up all these triggers, make sure the systems talk to each other, so on and so forth. They could go into a little company. They could go into a big company that's in any type of industry, from healthcare to finance to tech.
But wouldn't it make more sense, and this is just me, to find the industry and then find that person, as opposed to trying to shove something that people don't know? Like they don't know what RevOps is. They don't know what CRM is, right? So trying to push this position into a company that doesn't know what it is, versus saying like, okay, this company needs a home health aide, right? And finding a person that wants to get out of being a call center worker and wanting to be in a healthy profession. So
I think the answer is that the way in which we work today and will work tomorrow as well is we're all responding to open jobs that companies have. Right. So we're not saying like, hey, you should have a RevOps person, even though we don't have a RevOps function. We're serving the people that say, whether they call it RevOps or that it's like, I need a CRM administrator or Salesforce admin or whatever. Yeah. We're like, hey, we have a solution for that.
Person, or an analytics person. Yeah.
Or we can also do the same thing with your existing workforce. So you have people at your company that might want that job, but they haven't been exposed to how to do it or learn it. We can train them and you can help them move over. And so it's really like a holistic approach to solving the problem.
I like it.
Thank you.
I like it. No, that's awesome. And I think a really great type of, iteration, and having a lot of staying power. So like, what are your kind of thoughts from like a capitalization perspective, from a company building perspective over the next, 6, 9, 12 months?
Yeah. So for me, it's really tricky because, candidly, we're really hitting our stride. Like first half of last year was gangbusters. Right. And then it totally went in reverse because all the money was coming from recruiting fees, essentially from companies. And so we're going to have one of those stories where it like looks like the huge hockey stick, like going into a cliff. And then there's like another one after. And
Surprise.
So the challenge is, as you've laid out in, some of your stuff you talk about, which is perfectly logical. We haven't raised a lot, but we've raised $4 million.
Mm-hmm.
And we got past the $1 million mark and then we've sort of like hovered around there. And so we're just not at the place where by the numbers you would look at it and go, all right, let's go inject a bunch of money into this, right?
From a milestone perspective.
Yeah, that's right. That's right. And so for me, I think what's interesting is historically and early last year, I was looking at, and I think we talked then, and I'm like, yeah, everybody wants me to like take $10 million or whatever. And it's like, I'm just thinking like maybe few $1 million, like not because I'm not growth oriented or any of the talking points around taking money. It's just that like there is a much more efficient way to do this than just like, let's see how fast we can burn $10 million. So long story short, I don't know what the future holds for capitalization of the company. And I'm in learning mode, right? So I'm focused on the business. We're not too far from profitability or break even. I'm focused on the business and getting it at a place where, any investor would look at it and be like, yeah, I want those numbers are awesome, which is not where it's at the moment. And so that's my focus. And then when we get there, then it will become a question of what are the things that are actually possible? Like, can you raise single digit millions at this stage and like have it be fine? Do you have to take 20 million? Who are you taking it from? What are the expectations? All of it's just really interesting. And I hear so much talk about the reset and founders being able to accept new valuations and all of that stuff. And it's like, I don't think founders have any idea what the rules of the game are anymore. Right. Mm-hmm. And even if you say like, hey, we've swung to profitability and I don't think founders have any understanding of, okay, if I'm at this stage, like what should I be targeting? What kind of investors should I talk to? Mm-hmm. Like whatever. So I think
in fairness,
the market's confused.
Yeah. In fairness, I think the VC market's confused too. Right. When there's no IPOs, there's nothing to guide.
Yeah.
Right. There's no guidance there.
Right.
And, a lot of people who are new in this business, they don't know, what, margins are, like the rule of 40 and stuff that, we talked about in 2016, but everyone forgot about.
Yeah.
I was talking to a local investor in town and, we're talking about a company that's, $400,000 or $500,000. And, he took a not that much money, but took some money on a YC safe and, at a valuation cap that was like 15 and, there's like this like coastal series A and then there's like a normal series A, like a coastal series A, even in like normal, quote unquote, normal time, still 0% interest, but like 2016, 2017, you were still getting like, 5 to 7 million, on, 25, 30, 40 million bucks. And, that was, you were still a $2 million company. So you were still getting like a 20X, but like you had a much more substance behind you, right? In Arizona, or in any other undercapitalized markets, if you're in a, a vertical TAM type scenario, I mean, you're getting 7 to 10, bro, like 10 on the high side, right? And it just sucks. I mean, like if you go from 500K to 2 million and you put money at a $15 million valuation and all of a sudden like you after all that work, you're still at a $15 million valuation. Like that's just a shitty place to be.
It is, but I honestly think that enough founders will go through those moments of realization where they're like, okay, what am I trying to do here? And what do I need in order to do that? And if there's good partners to do that, like I think I'm game for it. But again, I think that there's so many assumptions flying around, right? Yeah. Even me, right? And I'm paying attention, I'm listening.
And you have a harder issue because you're a marketplace.
Yeah.
Right. And so it's like, okay, what's your take rate? Like you have two different unit economics, both on the supply and the demand side. I mean, yours is really fucking complicated.
Yeah. And the consistency between them, right? Like a lot of, I think part of our challenge from my perspective is that, we built something for the consumer. Like it was for them. It matters to the businesses and the businesses have paid for it, will pay for it, all of that stuff in normal markets. But ultimately the one with the most pain is that consumer. And I think that there's so much around like you learn being in this business, like you need to be a SaaS company, you need to, and all of that guides you towards that we've spent so much time trying to fit into that, that ultimately like the people that are benefiting the most are the ones that don't have the pockets to really pay for it.
Yeah.
In a really material way.
Well, right. And in a marketplace scenario, you're not just connecting employers to employees like a job board or, anything like that. You're actually providing value on a training layer that costs money.
Yeah.
Right. So your take rate could be 20%, even let's say on a good SaaS or marketplace, 30%. Right. But you still have this R&D expense, right, that goes into making product that, in turn should bring in EV, right, and create a competitive moat. But in the short term, like, that's a much harder proposition.
Yeah. And so, well, for us, we've been able to do it in a clever way where like our margins on the trainings, like, everything you would want it to be.
Okay.
It's all on demand, like so much automation in there, like all of that stuff does not cost us a bunch of money to acquire the content or create content of our own.
Oh, that's great. Yeah.
All of that stuff. So we've hacked like so much of this
that
we've really done a lot of the hard stuff. And I think we'll see that play out, as we go and scale through some of these things. But yeah, it's been tricky. I think the biggest thing is like we launched right before COVID. Then you have COVID, no one's hiring. So many people are out of work. And then it swings back to Great Resignation. Everyone's hiring. Then it swings back to like tech is imploding. And then
let's talk about Warren Buffett and Charlie Munger. And you know what I mean? Like it's nuts, man. It's sentiment. And nothing, I think when you talked to earlier about just alluding about things that, you know, I didn't know about, but just these events have just kind of shined light into it. It's just how emotionally driven and sentiment driven these markets are. Period.
Yeah.
And we're in a position, both you and I, right? This isn't just you. Like I'm in the position of, okay, I got to find a deal. I got to find the next deal, but that next deal, like I got to price it right or else I'm going to be fucked. And I got to do it where I don't screw the founder and the employees. They got to be motivated and it's got to be the right time and the right space. And, you know, they're selling into a market that's buying, right? you know, and there's like a lot of stuff. So we're both in an area of uncertainty, but like, I don't know, maybe that's okay.
It is okay. I think that for me, it's like there's the rules for investing on your side are so prescriptive. Everyone's following the same playbook. And to me, the people that are going to like be the breakout winners are the ones that actually have the guts to be like, I see that opportunity right there and I'm going to take it.
Yeah.
Like,
and this is hard, right? And I have
tough.
And I have to cut, but you know, that's what it is, right? I have to work harder.
Yeah.
You know what I mean?
Yeah.
Maybe I'm going to fire my chief of staff.
Yeah. Well, and for you, like you got to look at it and go, all right, I'm about to do something that I have to explain to someone as to why I did this. Because if I'm comparing this business to this business, like the one I'm picking, it's not the prettiest by the numbers or trajectory or whatever,
Right.
But I'm doing it. And that to me is like the mark of an outstanding investor. Very hard to do. I don't envy the position.
Very hard to do. And to your point, I've been reading a book called How to Invest. It was just syndicated on a bunch of different financial platforms, but it was by the guy from Carlisle. And like he interviews all the players, right? In hedge funds and bonds and equities and stuff. And they universally about halfway through it, everyone's like, you know, the real people that do really well in this business are the ones that like are continuously learning. Like you can never, there's no mastery. There's no 10,000 hours in this business because things change too quickly, right? Period. And the second is being able to see stuff that nobody else does. Yeah. And have courage because you only have to be right over half the time. Like you don't need to be right 100% of the time.
Yeah, that's right. And if we lived in a world where it was acceptable to take smaller bets, or still real money, no matter what it is, but smaller bets, then they won't be as catastrophic as when you dump $70 million into something that ends up being worth nothing.
Right. So you said you do some angel investing.
I did. Back before I burned so much of my money in the stock market and, running this little startup, making a fraction of what I used to make. I invested in a company called Deep Sentinel. I just did it through an angel syndicate. I'm not like directly on the cap table, but they do have my money and I will get a return. Yeah. Nice. It's a fantastic company. It's run by a guy named Dave Selinger, who founded a number of different companies, including Redfin. And it's just this badass home security product that I have, at my house.
Oh, so you're a product
I'm a
guy.
customer.
Yeah, you're a customer. Okay,
yeah.
cool.
So I'm a customer. So I've done that. And then I am a scout investor for Story Ventures. So
what's Story? Story
Ventures, they're my lead investor in Aspireship. I consider them just incredible investors. They just made a gut investment on me, like before we had product or team or anything. And they're very, very smart. They've picked very well. Their portfolio is pretty awesome. They're out of New York. They're young brothers that made a name for themselves through a few funds here. So basically I'm allowed to write small checks into companies I believe in.
Was that formal, that relationship? Like when you got in, did they have like a program, like a scouting program?
Yeah. So they actually approached me with it. This is new. It was only like, 3, 4, 5 months ago. They said like, hey, we're going to do an initial scout program. Like we're we're asking 10 founders that we know, that we, respect, would you want to do it? And I'm like, yeah, this is awesome. Cause someday I might be on the other side of the table. It's
not like your full-time job, but you have friends that will send you stuff and you look at it.
I just see stuff organically. And so like, if I want to do like a small check myself, I can. But of course the biggest thing is, I spot something that story might want to lead. And those are the things that ultimately I'd like to do.
Program. Yeah. I need a scout program.
Yeah.
I need a lot of things. I need a fucking analyst.
Well, hey, chat GPT it, right?
Chat GPT
There you go. Is Aspireship going to make it?
Yeah. I feel like chat GPT is just going to make a bunch of shitty content. Like it's just going to exacerbate worse content that's out.
It's like everything, right? It's like, even look at what happened with LinkedIn, right? So LinkedIn started with like a bunch of smart people started contributing content and whatever. And now it's just like anybody in the world is just like spewing stuff out there, and
still better than Twitter though.
Still, but yeah, I mean, like it's like anything. It gets out of hand for sure. But I am blown away by what's possible. We're already doing things in our business.
It's pretty cool.
Utilizing it. Yeah. And especially you get engineers involved, right? Yeah. The API and stuff. Yeah. Like there's a lot of really cool stuff. I am a bit concerned about what it could mean for the workforce. And it's not because there's going to be jobs that are taken up by technology. That's like what we do, right? It's just the pace of change. Right.
So do we need another jerk to the other way?
We have so much of that the last few years. And as we can see, things are starting to break. And then you introduce into it like, hey, you actually don't need 10 marketing people. You need 2 times everybody.
What does that mean?
Yeah. Right. And they got to go do something else. And, if the world's not ready for it, it can be a little painful.
And how important to you is building brand as a founder? Because you do. I mean, you've got a really great LinkedIn presence and profile, and I know it's important to you. So how do you think about that?
So my brand, like I don't care at all, other than for service of the business. Right. Like seriously, I really don't. I always tell my wife, like I don't want to be I don't want to be like Zuckerberg someday where everybody knows who I am and everything. Like that matters not at all to me. Company brand, I think, is incredibly important. And that to us, like in the early days, like we were able to just manufacture it, where then we had this just shining brand, and like the brand loyalty to us and the way people talk about us has always been so positive. And now it's put us in a position, I believe at least we'll put it to the test, where we can go expand into a whole bunch of stuff. And it'll just work because the brand is there. I think for our size, we have an extraordinarily powerful brand.
Yeah, no, I think so. It's definitely talked about too, right? In a good way, from people that I know in the business. And I know some people in my portfolio that look to people in your company for marketing and sales, go to market. So
that's awesome.
Yeah. So it's pretty cool. It's pretty cool to see. So thank you for coming in.
My pleasure. This was fun.
It was fun.
Probably not what you expected, or maybe it was.
I mean, dude, I just go, talk about don't care. I mean, I just go.
It's where the good stuff comes.
Exactly. If I have to start doing work for these things, I'm going to quit. A couple canned questions. What's your favorite book?
Founders at Work.
Okay. Best piece of business advice you've ever received?
It's a big world.
Oof. I like it. Everybody, thank you so much for tuning into the Capital Stack, where we talk to everybody, trying to get a little bit of edge on our own personal journeys of either founding companies, working with teams, or putting a little money to work. If you like it, please subscribe, tell a friend, and we'll see you next week. Thanks. Bye-bye.
Thank you for tuning in to the Capital Stack Podcast. Make sure to share this with someone you know that can benefit from this content. Remember to support this show by rating, reviewing, and subscribing. David Paul is the founder and general partner at DWP Capital. All opinions expressed by David and podcast guests are solely their own opinions and do not reflect the opinion of DWP Capital. This podcast is for informational purposes only and should not be relied upon for decisions. David and guests may maintain positions in the securities discussed on this podcast.